Every professional investor eventually asks the same question: what is this company actually worth? Not what the market says it's worth today. What is the underlying business worth based on the cash it generates? That question is at the heart of fundamental investing, and the tool most used to answer it is the discounted cash flow model. Today I'm going to show you how to build one using AI in under 10 minutes. Welcome to the AI portfolio. Every week I show everyday investors how to use AI tools to research stocks smarter and faster. I'm not a financial advisor. Nothing here is financial advice. And you should always do your own research before making any investment decisions. DCF valuation used to require a spreadsheet, a finance degree, and a lot of time. AI changes that. A discounted cash flow model is a valuation method that estimates what a company is worth today based on the cash it's expected to generate in the future. The core idea is simple. A dollar today is worth more than a dollar 10 years from now. So you project future cash flows, then discount them back to today's value using a rate that reflects the risk of the business. The output is an intrinsic value, a number you can compare to the current stock price. If the stock trades below intrinsic value, it may be undervalued. If it trades above, it may be overvalued. The gap between price and value is what investors call the margin of safety. A DCF model has 5 key inputs. First, free cash flow, the cash the business actually generates after capital expenditures. This is your starting point. Second, the growth rate, how fast you expect free cash flow to grow over the next 5 to 10 years. Third, the terminal growth rate, the long-run growth rate you assume the business sustains forever, usually between 2 and 3%. Fourth, the discount rate, also called the weighted average cost of capital, or WACC. This reflects the riskiness of the business and the opportunity cost of your capital. Fifth, shares outstanding, needed to convert total company value into a per share intrinsic value. Here's prompt 1 to gather your inputs. I want to build a DCF model for company name, ticker. Using publicly available financial data, give me the following: the most recent trailing 12-month free cash flow, the 5-year average free cash flow growth rate, the analyst consensus revenue growth estimate for the next 3 to 5 years, the company's current WACC, or an estimated discount rate based on its beta and capital structure, and the current shares outstanding. Explain where each number comes from and flag any that are uncertain or highly variable. This gives you a clean set of inputs with sourcing, so you know which assumptions to stress test. Prompt 2 builds the actual model. Using these inputs, free cash flow of X, growth rate of X%, terminal growth rate of X%, discount rate of X%, and X shares outstanding. Build a 10-year discounted cash flow model for company. Show the projected free cash flow for each year, the present value of each year's cash flow, the terminal value, and the resulting intrinsic value per share. Then compare the intrinsic value to the current stock price of EX and tell me whether the stock appears undervalued, fairly valued, or overvalued. You now have a complete valuation in plain English with the math shown. Prompt 3 is the most important one, testing how sensitive your valuation is to your assumptions. Run a sensitivity analysis on the DCF model for company. Show me how the intrinsic value per share changes if the growth rate varies between X minus 5% and X plus 5%, and if the discount rate varies between X minus 1% and X plus 2%. Present the results as a table with growth rates on one axis and discount rates on the other. Highlight which combinations still support the current stock price as undervalued. A DCF is only as good as its assumptions. This prompt shows you exactly how much your conclusion depends on getting those assumptions right and where your margin of safety actually lives. Here's the workflow. Start with prompt 1 to gather your inputs. Don't skip this step or use numbers you can't source. Then run prompt 2 to build the model and get your baseline intrinsic value. Then run prompt 3 to stress test it. If the stock still looks undervalued across a wide range of assumptions, your conviction is stronger. If it only looks cheap under the most optimistic scenario, that's a warning sign. The goal isn't to get a precise number. No DCF is perfectly accurate. The goal is to develop a range of reasonable values and understand what you need to believe about the business for the current price to make sense. 3 mistakes to avoid. First, anchoring on a single output. A DCF gives you a range, not a fact. Treat it as one input alongside qualitative analysis, not as a definitive answer. Second, using overly optimistic growth rates. AI will give you analyst estimates, but analyst estimates are frequently too high, especially for high growth companies. Be conservative and run your sensitivity analysis. Third, ignoring the discount rate. Changing the WACC by just 1 or 2 percentage points can move your intrinsic value by 20 to 30%. Make sure you understand what rate you're using and why. Your homework this week: pick one company you already own or are watching. Run prompt 1 to gather your inputs. Then run prompt 2 to get your baseline valuation. Don't worry about getting it perfect. The point is to build the habit of asking what something is worth, not just what it costs. That's it for episode 23. Subscribe for a new video every week on AI and investing in plain English. See you next time.